Every crash feels new when you're living through it. The faces are different. The technology is different, but the story never changes. 1929, 1930, 1931. Three numbers, three collapses, one pattern. It's the same silent rhythm that turns panic into profit, a cycle that the few understand and the many never see coming. Four stages repeating for a century. Stage 1, exit early. Stage 2, buy insurance. Stage 3, short the weak. Stage 4, buy the ashes. This isn't conspiracy. It's the blueprint of modern finance, a design that rewards patience, punishes emotion, and feeds on repetition. In 1929, Joseph Kennedy made his fortune not by luck, but by timing. He sold when the world was celebrating, when taxi drivers and shoeshine boys were giving stock tips. He knew that when everyone's an expert, the top is already in. In 2008, Michael Burry and John Paulson played the same tune in a new key. They saw through the illusion of endless housing growth, bought insurance on the collapse, and turned disaster into billions. And now in 2025, the stage lights are on again. The actors have changed Buffett, Bezos, Zuckerberg, but the script is the same. The richest investors on earth are liquidating their positions, while the public is still buying every dip. The headlines call it rotation. They call it profit-taking. But history calls it what it is, the first move of the pattern. Because markets don't fall from bad news. They fall from exhaustion when there's no one left to buy, when valuations defy gravity, when confidence replaces logic. That's where we are right now. The numbers are screaming, but no one is listening. Buffett holds $325 billion in cash. Insider selling across corporate America is the highest since 2007. The Buffett indicator market cap to GDP is at 185%, the most overvalued in recorded history. It's not fear, it's preparation. Every generation thinks it's different. Every generation believes the new era will never end. And every generation learns too late that the pattern always wins. The first stage has already begun. The exits are quiet. The crowd is still cheering, and history is repeating itself. Now let's step into stage 1, the silent exit. Every crash begins long before the first headline. It begins quietly behind closed doors in boardrooms and private trading floors when the smartest money in the world starts to leave. In 1929, the man who saw it first was Joseph P. Kennedy. He wasn't a prophet. He was a speculator, one who understood that markets die the same way people do, first with euphoria, then with silence. By the summer of 1929, the U.S. stock market had become a casino. Margin debt exploded. Investors were borrowing 90% of their positions to buy more stocks. It was a pyramid of leverage standing on greed, and Kennedy could feel the air getting thin. He began to sell quietly, methodically. One story says a shoeshine boy offered him stock tips, and that's when he knew it was over. But the truth runs deeper. Kennedy understood forced liquidation, that a mere 10% drop would erase investors who were 10x leveraged. When they fell, they'd have to sell, forcing others to sell too, a domino effect of panic. So he left early. And when the crash came 7 weeks later, Kennedy wasn't a victim. He was a buyer funded by the profits from his exit. Fast forward to 2008, another mania, this time in housing. Subprime loans, mortgage bonds, and infinite optimism. Michael Burry saw it coming in 2005. He looked at the data and found lies, fake incomes, teaser loans, unpayable debt wrapped in now AAA labels. He didn't know when the collapse would come. He only knew it was inevitable, so he exited the consensus and positioned for disaster 2 years early. His investors called him insane. Then the world collapsed exactly as he predicted. And now, 2025. The same pattern. Warren Buffett holds the largest cash pile in corporate history, $325 billion. Jeff Bezos has sold $13 billion in Amazon stock. Mark Zuckerberg, billions in Meta. Even Jamie Dimon is selling shares in his own bank for the first time in his career. They're not guessing, they're signaling. Insider selling is now at its highest level since 2007, right before the last crash. This is stage one exit before panic. Sell into strength. Leave quietly while the crowd still celebrates, because when the crowd realizes the music stopped, it's already too late. Stage one is silent. Stage two is invisible. Because while most investors are still celebrating their paper profits, the smart money starts doing something that seems insane. They begin paying to lose money. That's what buying insurance looks like. It's the act of accepting small guaranteed losses today to prepare for massive gains tomorrow. And every financial genius who survived a crash has done it. In 1929, Joseph Kennedy didn't just sell. He began shorting the market, borrowing stocks to sell high and buy them back cheap after the collapse. It was a painful waiting game. For weeks, stocks kept rising, and he paid fees on borrowed shares. The crowd mocked him for being early. But when the crash came in October, his short positions exploded in value. While fortunes evaporated overnight, Kennedy made the equivalent of hundreds of millions. In 2008, Michael Burry and John Paulson repeated the move with modern tools. They bought credit default swaps, insurance contracts that paid out when mortgage bonds defaulted. From 2005 to 2007, they bled cash every month as the housing bubble inflated. Their investors screamed. They wanted out, but Burry refused. He knew the premiums were small compared to the coming payout. Then it happened. Subprime defaults. Bear Stearns collapsed. Lehman Brothers vanished. Burry and Paulson's funds made billions. Their insurance paid off exactly as designed. And today in 2025, stage two is repeating itself. The instruments are different, but the strategy is identical. Hedge funds are loading up on put options, VIX calls, and credit default swaps on commercial real estate and regional banks. The put-to-call ratio has remained above 1.0 for months, a rare signal of institutional hedging. VIX options bets on volatility are being bought in massive blocks expiring in late 2025. They only pay if the market collapses. Someone is paying millions in premiums. And to wait, because the pros know what the public doesn't. Insurance isn't bought after the fire. It's bought while everyone insists the house is indestructible. The smart money is already insured. The crowd, as always, is still dancing on dry kindling. If stage one is about leaving quietly and stage two is about preparing in secret, then stage three is the moment when the smart money takes aim, not at the market in general, but at its weakest arteries. This is where fortunes are made. In 1929, Joseph Kennedy didn't just bet against the market. He targeted the most over-leveraged stocks companies propped up by borrowed money and blind faith. When the panic began, those names fell first and fastest. Kennedy's short positions hit like precision artillery. By the time the dust settled, while 89% of Wall Street was wiped out, Kennedy was richer than ever. In 2008, the same pattern repeated with surgical accuracy. John Paulson didn't short everything. He shorted the worst mortgage bonds, specific tranches of subprime loans from Florida, Arizona, and Nevada. Loans with teaser rates that would explode in 2007. Borrowers who lied about income who couldn't afford payments once they reset. He studied the data, found the weakest link, and bet the house. When the defaults hit, those bonds went to zero. Paulson's fund made $15 billion in profit, the single largest trade in Wall Street history. Now in 2025, the weak links are hiding in plain sight. Commercial real estate and regional banks. Two sectors built on old assumptions, cheap money, full offices, endless growth. none of which are true anymore. Office towers in major cities sit 40-50% vacant. Companies that once leased 5 floors now lease 2. The loans on those buildings taken out at 3% interest must soon be refinanced at 8%. The math doesn't work. Over $2 trillion in commercial mortgages come due between 2025 and 2026. Defaults are inevitable. Who holds that debt? Regional banks. Not JP Morgan or Goldman, they're too big to drown. But smaller institutions in Chicago, Dallas, and San Francisco banks, whose portfolios are 30-40% commercial property loans, they are sitting on losses they haven't yet admitted. And the hedge funds know it. They're shorting commercial mortgage-backed securities, and the regional banks most exposed, the same way traders shorted mortgage bonds in 2008, just a new name, a new bubble, the same decay underneath. This is stage 3, the precision strike. Target the weak. Wait for gravity. And when the first cracks appear, the collapse moves faster than anyone expects. Every empire of speculation ends the same way in silence, fear, and fire. And in that fire, the few who prepared step forward to claim what's left. That is stage 4, the phase that separates survivors from legends. It's not about prediction anymore. It's about courage. In 1929, the panic burned for nearly 3 years. From its peak at 381, the Dow collapsed to 41 by 1932, an 89% loss. Factories closed, fortunes vanished, and unemployment climbed past 25%. Yet in that abyss, Joseph Kennedy re-entered. He bought distressed businesses, bankrupt railways, and stocks trading for less than the cash they held. He purchased real estate from desperate sellers who'd lost everything. While others hoarded pennies, he accumulated power. By the mid-1930s, Kennedy's wealth had multiplied tenfold, funding not just a dynasty, but a new era of political influence. He didn't escape the Great Depression, he used it. In 2008, the collapse was faster, but just as savage. The S&P 500 fell 57%. Fear was absolute. Headlines screamed Great Depression 2.0, but that's exactly when Warren Buffett acted. In September 2008, as Lehman Brothers imploded and the world thought the financial system was finished, Buffett wired $5 billion to Goldman Sachs. He received preferred shares paying 10% interest and warrants to buy common stock at half price. When markets recovered, those warrants were worth billions. He made similar deals with Bank of America and General Electric, each struck at the height of panic. Buffett's principle was simple: be fearful when others are greedy, and greedy when others are fearful. And in 2020, when the pandemic froze the world, Bill Ackman did it in real time. He made $2.6 billion in March betting on collapse, then within days used that money to buy stocks like Starbucks, Hilton, and Lowe's while they were still burning. 3 months later, markets rebounded violently. Ackman doubled again. Stage 4, perfection. Now in 2025, the stage is being set once more. The dry powder is already waiting. Buffett's $325 billion in cash, Blackstone, Apollo, and Carlyle with record private equity reserves, sovereign wealth funds quietly positioning for liquidation events. When the crash hits, when commercial real estate defaults cascade, when regional banks fail, when the crowd screams the end, these players will buy everything. Not at discounts, at giveaways. Because panic is the only time power changes hands. And stage 4 isn't about timing the bottom. It's about being ready when the fire clears. If you've noticed something about this pattern, it's not just financial. It's psychological. The markets don't crash because of mathematics. They crash because of emotion. Every era believes it's smarter than the last. Every generation of investors tells itself, this time is different, and every time it's not. In the 1920s, it was radio stocks, margin loans, and the new era of endless growth. In the 2000s, it was real estate and mortgage-backed securities safe as houses. Today in 2025, it's artificial intelligence, crypto ETFs, and perpetual zero-down financing for everything from Teslas to skyscrapers. Different assets, same psychology. The pattern always begins with greed disguised as innovation. New technology, new valuation models, new narratives, all used to justify excess. Then comes leverage. Borrowed money multiplies gains until it multiplies losses. That's when fear arrives uninvited and unstoppable. And finally, capitulation, when even the strongest hands sell to survive. The truth is brutal. Markets don't rise because people are smart. They rise because people forget. In 1929, the crowd believed the Federal Reserve had ended recessions forever. In 2007, they believed complex models made housing prices unbreakable, and today they believe central banks can print prosperity without consequence. But cycles aren't broken by belief. They're broken by math. Right now, total U.S. debt, public and private, exceeds $100 trillion. Interest payments alone are approaching $1.2 trillion per year, more than defense or education. Corporate debt is at record highs, and consumer delinquencies are rising fastest among Gen Z, the most leveraged young generation in history. This isn't doom, it's arithmetic. Every bubble builds on the same foundation: debt, confidence, and denial. And every collapse begins when one of those cracks. That's why the four-stage pattern exit, ensure, short, and buy, is timeless. Because it's not about markets, it's about human nature. The crowd will always chase the high. The insiders will always prepare for the fall. And in between those two instincts lies the transfer of wealth that has repeated for a century. As long as greed exists, so will this cycle. And every time it returns, it will look new until it ends the same way. We are now standing at the edge of the next reset, the moment where everything built on easy money begins to unwind. The signs are not subtle. They're glowing red in plain sight. The yield curve, the most reliable recession signal since 1950, inverted in 2023 and has now normalized. Every time that's happened, a recession followed within 6 to 18 months. It's been 20 months. TikTok. Corporate insiders are selling at record pace, over $120 billion in stock dumped in the last 12 months. Buffett's cash hoard, $325 billion, is not a coincidence. It's dry powder for stage 4. And the commercial real estate time bomb, $2.2 trillion in loans maturing, is already ticking. Every data point is whispering the same thing: the pattern is in motion. But here's the uncomfortable truth: most people won't prepare. They'll dismiss this as fear-mongering until it's too late, because the final stage of every bubble isn't denial, it's complacency disguised as optimism. You don't need to be a billionaire to survive the reset. You just need to act before the crowd. 1. Hold liquidity, not zero-yield cash under the mattress, but short-term treasuries, money markets, instruments that can move instantly when opportunity strikes. In every collapse, cash isn't trash, it's oxygen. 2. Reduce leverage. Debt is fuel on the way up and fire on the way down. The less you owe, the longer you can breathe. 3. Buy real assets when the dust settles. Land, businesses, commodities, things that produce value regardless of currency fluctuations. Every great fortune of the last century was built by those who bought real things when paper wealth burned. 4. Watch the fear index. When the headlines say Great Depression 2.0, when CNBC panels panic, when everyone swears capitalism is finished, that's your signal. That's when you buy. Not before, not after. At the bottom of despair. Because the reset is not the end of the system. It's the cleansing of it. The crash transfers wealth, not destroys it, from those who panic to those who prepare. And when the dust finally settles, when stage 4 begins, and the smart money returns to the ashes, the question won't be, did you see it coming? It will be, were you ready to act when it did? The pattern has spoken for a century. It's speaking again in 2025. And if history holds the greatest collapse and the greatest opportunity of our lifetime are about to arrive together,